per barrel, as the outage from the recent leakage of the Keystone Pipeline put a floor under oil prices and paved the way for a rally in crude prices. At the same time, the prospects for a gradual reopening of China further supported oil prices due to prospects of increased demand levels from the second largest consumer of oil. On the contrary, a somewhat bleak outlook for oil demand growth for 2023 was reported by IEA earlier this week, as the agency foresees a slowdown of global economic activity due to persistent inflationary pressures, and high interest rates could dull the demand for oil, prompting energy traders to reconsider their bullish outlooks. In this report, we aim to shed light on the catalyst driving WTI's price, assess the future outlook, and conclude with a technical analysis. Last week, one of the biggest pipelines that transports crude from Canada to the US was reported leaking. The Keystone Pipeline, which ships more than 600,000 barrels of crude per day from Alberta, Canada to the Gulf Coast of the US for refining, has been found leaking, and authorities have not yet identified the cause. According to experts' reports, the incident attracted concerns from locals as well as the Environmental Protection Agency, as the spill, if not contained in due time, could determinately affect surrounding farmers' crop yields. The contaminated area is currently being cleaned up. However, it is expected to last for weeks, and there is still no official timeline for the restart of the pipeline. The event constitutes as the largest crude oil spill in nearly a decade in North America. The disrupted supply, alongside the uncertainty surrounding the resumption of the crude flow towards the US, was evidently the main driver behind the rebound of oil prices from the year lows and its sustained upside momentum seen during this week. Should the situation deteriorate further, we would expect oil prices extending their winning streak, climbing to higher ground. Energy traders had to grapple with prospect of increased demand outlook from the largest importer of crude, China, as the government slowly started to shed away to strict COVID-0 policy rules. That being said, infection cases continue to pile on and hit record highs across many major Chinese cities, and according to a recent study, COVID-19 related deaths in China could reach 1 million. Should such a scenario materialize, there may be increased pressure on authorities to reconsider and possibly scale back the reopening plans of the country. On the flip side, economic releases earlier this week, namely the industrial production, has reported a softer than expected increase in the month of November, advancing by 2.2% compared to the expectation of 3.6%, practically implied that the country's manufacturing output capabilities have been capped by lockdown measures. Overall, the reopening hope seems to provide a floor under oil prices this week, and traders appear optimistic about a potential upside for crude. EIA short-term outlook shares the same conclusion as the Energy Agency, which stated that while restriction levels in China remain high, the stage is now set for a progressive reopening in 2023. We have raised our estimates for 2022 and next year growth by 50,000 BBT and 40,000 BBT respectively. Looking further ahead, the agency noted that as we move through the winter months and towards a tighter oil balance in Q2 2023, another price rally cannot be ruled out. Thank you for watching.